Principles of Accounting, Chapter 24. In Chapter 24, we're going to talk about looking at actual versus budgeted information. So in Chapter 23, we prepared budgets. So the standard costing system is our per unit cost expected under normal operating conditions. These are often the amounts that we use for our budget. So this is what we believe is going to happen based on our historical accounting information that under normal circumstances, these are the costs that we would have for materials, direct labor, and overhead categories. We compare our actual costs with our standard costs and our budgeted information to show us if there are any issues in our operations. So we're going to be looking at variance analysis in this chapter. Variance is the difference between our actual and standard input. So it's favorable when our actual costs or quantities are less than standard, and unfavorable when our actual costs and quantities exceed that standard. This is an example of a standard cost system with the actual and standard costs and quantities. So we have what the actual quantities and costs are assigned to various accounts. So direct materials, we have actual quantity and actual cost. And the variance between that is the difference between our actual quantity and the standard quantity, and our actual cost and the standard cost. This is also true of direct labor and overhead. So then our labor variances are the differences between what our standards were for our budget and what actually occurred. And overhead variances happen between what was our estimated overhead based on our standard cost versus what was our actual overhead based on what actually happened. When we're creating those standard costs, they're revised each period during our budgeting process. So we want to make sure that we're reviewing them periodically to revise them anytime that there are significant changes in the prices that we pay for materials, labor, and or overhead. Especially in times of high inflation or when costs are increasing, we want to make sure that we're taking that into account when we're looking at our standard costs. Under perfect situations, we wouldn't have any efficiencies in our production process. There would be no waste, spoilage, vacations, fatigue, machines would never break down in any of those situations for perfect circumstances. Those are unrealistic and would result in budgeted standards that are impossible to achieve. So our level of expectation has to be something less than ideal. We have to choose a realistic capacity. So that's why instead of saying ideal conditions, we generally say normal conditions. Like, what is our normal capacity? Not what is the amount of capacity we have available to us, but what is our actual normal of production. First, we're going to talk about direct materials standards. So the first step in establishing our standard cost is identifying the actual materials that we need to produce each product. So what is our quantity of material and what is the cost of that material? So in this example, we're looking at making pizza. So what is the standard cost of mozzarella cheese? So we have the standard cost is $2.40 a pound. So if we normally use a quarter of a pound on a regular pizza, then the standard cost of cheese per pizza is 60 cents, or $2.40 times a quarter pound. Other things that we have to consider when we're looking at direct material standards are this relationship. So remember, everything when we're looking at in costing, we're looking at a relationship and what drives those costs. So for example, high quality materials generally cost more than lower quality materials. However, lower quality materials can create more waste, more spoilage, more product defects. So that's a balance between, do we spend more for materials or do we potentially have costs associated with using low cost materials such as waste, spoilage, and product defects. So that's something that we have to weigh when we're looking at our standards. The cost and quality of materials used in production is key in determining our prices, especially when we're using full cost to determine what our eventual selling price is. It also can affect customer demand. We might have customers that will pay more for higher quality, or our customers might be looking for just the lowest cost. And so then that's another factor in our decision. Are we trying to find the customers who are looking for the high quality and are willing to pay for it? Or are we trying to draw the lower cost customers who are willing to buy any product, they just want it to be the lowest cost product? We also have to think about storage, availability, any disposal, and shipping costs. So where are we going to store those direct materials? When are they available to us? Are there times that we're going to have shortages that we want to stock up so that we don't run out? What are our relationship with our suppliers? Where are we getting those materials from? Could there potentially be shipping delays, whether they're coming from inside the US or outside the US, and how that extra shipping time can affect them? Our direct labor standards. So setting those direct labor standards usually includes what our hourly wage rate is and the amount of time allowed to produce each product. So in this example, our employees are paid $15 an hour. And we assume that to produce a table takes 3 hours. So the standard direct labor cost per table is $45, or that $15 per direct labor hour times the 3 hours required to build that component. We often need to have input from a variety of people about what those direct labor standards are. We can easily find out what the direct labor rate is per hour, but we don't always know how much time it takes to produce a unit of something. And we need to also think about if it takes new laborers more time to build something than it takes experienced laborers, and are we going to create an average time based on how long our factory employees have been on staff? Or do we look towards a time that you have to be fully trained in order to hit? Then our manufacturing overhead standards. So our standard overhead cost per unit is based on an estimate of our total overhead at the normal level of production. This is true whether we use activity-based costing or a plant-wide rate or a departmental rate. It's based on what our normal projected estimates are. So overhead is applied to production at our standard cost per unit. Then if we need to make any change to it, we generally have to make changes to our entire overhead rate. So we look at this example. So we have standard costs and the computation of variances. We're looking at operations of Bruce Mills. The company's major products are laminated wooden beams used in the construction industry. We have 2 steps. First, Our 2-inch by 12-inch boards of varying lengths are cut from rough white pine lumber supplied by wholesalers from the Pacific Northwest. These boards then are glued together like a sandwich to form a laminated beam. Information that we have about the production and materials. So we manufacture a beam which is 20 feet long and requires 6 layers of pine boards. At normal capacity, we produce 700 of these beams each month. Direct materials. Due to inherent defects and waste in materials, the company allows 264 board feet as the standard quantity for each 20-foot beam manufactured. The standard cost of rough white pine is 25 cents per board foot. So the standard cost of direct materials is $66 a beam. Now our direct labor. So we convert rough lumber into boards suitable for finished beams. It requires that boards be cut and planed, glued together, pressed and coated with a protective sealant. We've established a standard of 1.5 direct labor hours for each beam. Our standard labor rate is $12 an hour, so our standard direct labor cost is $18 a beam. For our standard overhead costs, we have fixed manufacturing costs. These are those costs that are not affected by short-term changes in the level of production. These are usually contracted costs that we are locked into for a minimum of 1 year. This includes supervisor salaries, depreciation on equipment, property taxes on the factory. Our variable manufacturing costs rise and fall in proportion to changes in production volume. Our variable overhead costs are machinery repairs, electricity, and indirect materials. So for our Bruce Mills Company, we budget fixed overhead relating to the production of beams at $5,600 per month. Under our normal production level of 700 beams per month, this equals $8 per beam. And we apply variable manufacturing head using direct labor hours as an activity base. So our rate is $4 per direct labor hour. So given that 1.5 direct labor hours are allowed per beam, we expect to incur $6 per beam in variable overhead. Therefore, our standard cost for overhead is $14 per unit, $8 in fixed costs, and $6 in variable costs. So we see on this slide, we have our standard cost per unit, $66 in direct materials, $18 in direct labor, $14 in manufacturing overhead. So our standard cost per unit is $98 per 20-foot beam. We'll look at the comparison to actual in the next video.